All right, great. We're very happy to have Nirupama Kulkarni today with us. Nirupama is a senior research director at CAFRL. Her areas of research are banking, household finance, real estate, and monetary policy. She has an undergraduate degree from IIT Bombay, MBA from Stern School of Business, NYU, and a PhD from Haas School of Business, University of California, Berkeley. Nirupama has published her work in excellent finance and macro journals like the Journal of Monetary Economics. I would urge all of you to go and check out her excellent published and working papers. Today, she will present her work on the appraisal gap, disparity in collateral assessment. Nirupama, thanks for agreeing to give a talk. We are very happy to have you, and you have 1 hour and 15 minutes to present your paper. This includes questions. It's up to you if you want to take questions on the go or defer them towards the end. With that, the floor is yours.
Sure. Thank you. Thanks, Girish, and thanks to the organizers for inviting me. So I would like questions, throughout, so it's that I can sort of address them as we go along. It's important that you get what I'm doing instead of me like rushing through all my slides. So this is a paper. This is like the first time I'm presenting. So I'm from CAFRAL, which for those of, I think most of you would have not heard of it. So this is a research organization set up by the Reserve Bank of India, the Central Bank of India. And so my dissertation, when I was doing my PhD, I actually focused a lot on mortgage markets, on real estate. But after coming to India, I shifted away a bit from this because there was not that much data available. And this is one of the first papers that now started getting access to more data, and so this is one of the first papers that I have come out with on mortgages. I'm sorry, since I can't see you, I'm a little, yeah, okay, you're still around. Okay, so let me just get started. So the broad motivation for this paper is basically there has been a lot going on in the real estate sector in India. And there's been a big policy push, especially to increase homeownership. And the government has put out a number of affordable housing goals. For example, even in the most recent budget, certain middle-class households they were sort of targeted, and many schemes were released which helped them. So this paper is more about appraisal values. Appraisal values of homes basically determine collateral values by lenders and determine basically the amount that the lender is willing to give a borrower. And so more precisely, appraisal gap is defined as the difference between what the appraiser, which is basically a person commissioned by the lender, so what the appraiser appraises the value of the property, and the actual value of the property as on the sales deed. And this difference can actually vary across borrowers. So in the US, this has received much attention. There was a much older literature, and again, more recently, there's been a big push. There were these set of Brookings papers, which basically documented that appraisal gaps differ, especially for minority borrowers, so Black and Hispanic borrowers. And not just in the sort of the policy side, but also, or more specifically the academic side, but also on the policy side, the government-sponsored enterprises, which in the US, which basically determine who gets access to mortgages. They have started putting out these estimates of these appraisal gaps by neighborhoods, and basically as a way to track whether there is disparity in these appraisal values. There is also like this very famous case where basically there were these Black homeowners who had got their home appraised, and they got a certain value. They thought this was much more of a lower figure, and so then they got it appraised again the second time. But the second time they made sure that there was there was no identifying information. So they removed all their pictures and so on, so that nobody could make out that this actually belonged to a Black homeowner. And the second appraisal that they got was actually a higher value. And so they used this to sue the lender and actually won the case. And so the most of this literature has basically documented, these are mostly policy papers, not so much on the academic side, but these papers that document this disparity in appraisal values for minority or historically disadvantaged groups. Um, the underlying assumption is that this might be driven by some kind of bias, though there's not that much work on exactly what are the mechanisms driving this. And not much has been done in developing countries, and I think this is mostly due to the paucity of data. Um, and this is important because the channels, the mechanisms that are driving some of these differences might be very different in a developing economy versus developed economies. And so the broad research question is, are there disparities in appraisal values for minority borrowers in India? So let's fix ideas. The appraisal gap is basically the log of appraisal value by property value. And so the property value will be what basically it's on the sales deed, and the appraisal value is what the lender works off of to determine, basically put a loan to value and then determine the value of the loan that he's willing to give a borrower. And in this paper, we document disparities in appraisal gaps for minority borrowers, and more specifically Muslims who belong to the minority religion, and the minority castes, which is other backward classes, OBC and SEST, scheduled castes and scheduled tribes in India. And I think the meat of the paper is in pinning down the different mechanisms and channels that drive this gap. And also there has been a lot going on in the real estate market. Many of them which are not specifically targeted to minority borrowers, but more broadly addressing different inefficiencies in the market. And some of the solutions to driving this gap down actually lies in these kind of market-based solutions. And so I'll look at a number of possible solutions based on recent regulatory changes. So just to give you a preview of the results, the first set of findings is basically documenting the appraisal gap. And we find that the appraisal gap is greater. That is, appraisal gap is lower than property value. So, the way I've defined it, it means it's more negative for minority borrowers. So the appraisal values imply that there is 17% assessed value, appraised value 17% lower than the property value, and this is in the aggregate. There's also heterogeneity across minority borrowers. So the Muslims borrowers fare better than relative to that. OBC borrowers fare relatively. They have like lower appraisal values, and then at the bottom is SEST. And in rupee terms, this is about 400,000 rupees, which roughly translates to $5,000 decline in the loan amount for minority borrowers on average. And I also document significant spatial variation. So of this 17%, 32% is attributable to pin code level effects. And you also see this appraisal gap sort of differ for minority borrowers, especially in neighborhoods which have a high minority fraction, in segregated districts, and in poorer neighborhoods. And the effects are very they flow through in the same direction as we would expect, and this also gives some comfort in these appraisal gaps are not being driven by some weird quirks in the data. And this is where the meat of the paper is. So we look at mechanisms and then also look at corresponding solutions, possible solutions. So the real estate market is very opaque. It has a lot of black money, or basically money from off the book money, basically where households or borrowers get this money just because they're trying to evade taxes. And so we rule out informality or black money component as a mechanism. We also don't find that this is driven by borrowers' creditworthiness. Instead, we find support for asymmetric information about collateral values between the borrower and lender. And so this we tackle in in a couple of ways. We find one, the prior literature, especially in the US, has seen that when the lender is lending to borrowers where the property is from vertically integrated developers, then there's less information asymmetry about the exact quality of the collateral. And so we exploit the same kind of idea. That is, we look at the properties of vertically integrated developers, and we indeed find that there are narrower gaps. There's also sorting of borrowers to worst developers. And there was a big regulatory change in 2016 and subsequently in 2018, where this big regulatory change, the Real Estate Regulatory Act, essentially made sure that home buyers' interests were protected, and it actually cleaned up the real estate space, specifically developers. And so we find that there's a very positive effect of this, especially for minority borrowers, and in some cases even differentially so for minority borrowers. And the last part, we look at property rights. So India has poor property rights. Now we look at the Delhi as a case study, and then we also document that the poor property rights, both in terms of ex ante, there's no clear titling, no clear property rights, as well as poor enforcement of these rights, are driving this gap in place. So the related literature, there is, like I said, there is a large literature on appraisal valuation, and this is a very early literature, but it has received more renewed attention, especially in real estate. And most of these papers basically, document the sources of appraisal valuation. And more specifically, why should appraisal values differ from sales prices? It could be that borrowers disagree, or borrower and lender disagrees, and this is a paper that basically points to that. There could be information asymmetries, and there's this very nice paper by Strobel, which documents how, like I just mentioned, which documents for properties where the property comes from vertically integrated developers, the appraisal, it's not the appraisal value, the price of the properties, or the loan amount that the lender is willing to lend the home buyer is actually much higher. So these actually point to appraisal values differing from the property value or the sales price. But there are also papers which document why an appraiser might be more inclined to keep the appraisal value exactly at the property value. So if this gap is actually negative, that is appraisal value is less than property value, then maybe the deal might not go through. On the other hand, if the appraiser appraises the property value or appraises the true value as higher than the property value, then there might be a credit risk. So instead, there's this sort of, and you'll see in the data that I have also, that there is a tendency to bunch around zero, because appraisers in general tend to estimate the appraisal value at exactly the property price. And these are the Brookings papers that I had just mentioned, where they also document, and I think this is the most similar to my paper, which is they also document this gap between appraisal values for minority borrowers, that is Black and Hispanic borrowers. And so the first part of the paper is basically documenting appraisal gaps for a large developing economy, which I don't think has been done because of, again, paucity of data. This paper is also related to property rights. So there's a long literature. This is a very nice paper by Besley and Ghatak, who basically look at this is a handbook chapter, and they basically make the point that property rights determine, a bunch of things like expropriation risk and the ability to rent out these properties and so on. And they also end up determining how efficient the financial markets are. There is empirical evidence that improving property rights can improve investment. So this is mostly in development economics, and these papers document that giving land titling or improving land titling improves productivity of the land, either because the landowner is willing to make more investment in the land. More broadly, there's mixed evidence on credit. So improving property rights might not really increase access to credit. And so the mechanisms driving these appraisal gaps, as I will show you, is actually determined by property rights. And so the mechanisms driving differences might differ for something like the US compared to India. And so our policy solutions will also differ. I'll just stop here. So moving on to the institutional details. So the data itself is going to come from a large state-owned bank.
Excuse me. I mean, just to clarify. So basically, you're gonna document this this gap between appraisal and the property values, but you'll not be able to identify the source of this gap. Is that right?
I'm going to attempt to I'll try to rule out different channels, and then I'll try to determine exactly where the gap is coming from.
Okay.
But if you're saying whether I can decompose like everything that drives the gap, maybe not. But I'll be able to, rule out channels and tell you like some channels where
the leftovers. Okay.
Yeah.
Thank you.
So the state-owned banks account for a large share of housing loans by value and volume. This is so the numbers mentioned here come from Credit Bureau. As of December 2020, the top 5 state-owned banks own nearly 30% of home loans by value, and this share has actually been increasing. The real estate markets in India are opaque and plagued by massive inefficiencies. A lot of this is driven by this black money actually infiltrating the market. It's actually a vehicle for storing, money which was where which comes from the informal side, where this parallel economy, where they were basically trying to evade taxes, and so they're basically off balance sheet. And there's been a massive regulatory push for reforms, especially in the past decade. I'll go into the specifics of this when I come to the mechanisms, but more broadly, there was the 2016 Real Estate Regulatory Act, which basically protects home buyers' interests and regulates developers. So this act targeted developers and made sure that these developers were basically registering the projects, making sure there was an escrow account, and just basically cleaned up the market so that home buyers who were buying from developers knew what they were getting into. The Insolvency and Bankruptcy Code, this was our bankruptcy code that was passed in 2016, and this was targeted more towards corporate loans. But in 2018, the IBC was amended so that home buyers could also initiate insolvency proceedings against developers. And again, I'll come to the very specifics of it when I come to the mechanisms section. And there were a bunch of other regulations that also improved property rights. And so there's been this massive effort to basically digitalize property and land records, which again just makes it clear who the property belongs to or the land belongs to. The property rights itself, there's a lot of heterogeneity across regions. So we're going to focus, especially the empirical exercise when I'm looking at this specific mechanism, focuses on Delhi. And you'll see that many of the issues there are very specific, to a particular region. So what is the appraisal process? The appraiser is commissioned by the lender, and these are certified agents who are independent of the lender and the borrower. The appraisers base their estimate on several factors. So they look at location, size, condition, amenities, the recent sales of comparable properties. And this basically, the appraisal value determines or helps the lender assess the collateral value and determines the loan amount that he can then give the borrower. In India, these property appraisals are in fact a regulatory requirement. So the main data set is loan level data. So this is mortgage data from the largest public sector bank. And it has very nice details on the loan contract terms, so loan size, interest rate, maturity, loan performance, as well as on the underlying property. So property details like the square feet, the carpet area, the property value, the appraised property value, which is very important for our analysis. And also there are several borrower characteristics. One is CIBIL's, the credit score, which comes from a credit bureau. And there's also very detailed information on caste and religion. And this data is available from 2010, but we focus on the period from 2015 because there's also information collected by the lender on these vertically integrated developers only starting in 2015. And so what is a vertically integrated developer? Basically, the lender will have a tie-up with a developer, and the borrowers purchasing properties in the projects of this developer they'll basically have a little bit more easier access to loans from the specific lender. And then we have about 1 million loans, and I do some cleaning where we retain loans with no missing appraisal values, property values, interest rates, loan to values, religion, caste variables, and also an important source of variation is going to be the spatial variation. So I also retain only those loans where we have good geographic information. And we drop some of these outliers, that is if interest rate is lower than 2% and if age is above 80 years. In our data, I codify minority as Hindu, OBC, SC, ST, and Muslims, and non-minority is Hindu general category. And also for looking at property rights, we scrape data for Delhi on disputed properties for about 25,000 disputed properties. Okay, just some broad summary statistics. On average, the loan values are about 1.87 million. And loan value is about 59% or 60%. This is a little bit lower than, say, what one would see in the US, which is closer to 80%. And the default rates are also low. This is about 1%. Interest rates are around 7.5%. And this is at the mortgage level, and at the PIN code level, the data looks similar. And then I just look at the minority and non-minority, and even in the aggregate, you see that for minority borrowers, the
Nirupama, sorry, I know you can't see anyone, so I'm just letting you know that there's a question by Leandro.
Okay, please go ahead.
Leandro, you're on mute. Leandro, you're on mute.
Sorry, is this interest rate? I suppose nominal interest rate. What is the real interest rate?
So it differs. I think you can, the target is between 2 to 6% for and inflation would be around, I would say about subtract around 5%, 5 to 6% from this.
6%. Okay. So okay. So, and this is annual interest rate, right?
Yeah, this is annual interest rate.
And is there any, for example, extra repayment that's need to be done on the top of the mortgage or on the mortgage?
Repayment or it could be, though it's not recorded. But this is loan origination data, and I think, like, there could be some discounts on the side which are not captured here.
Oh,
does it answer? Yeah.
Yeah, because I mean, based on if you are obliged to make some, I'm not sure the details there, but I mean, if you need to pay on the top of the interest rate, you need also to make some extra payment. I mean,
Right.
Have to be factored out. Okay, that's okay. Thank you.
Yeah. And these are also ARMs. They're adjustable rate mortgages, but there is actually a very tight band around these adjustable rate mortgages. So, for example, I don't have the rate sheet here, but basically, if the interest rate is about 7.5%, then they can't exceed beyond, say, 8%.
Nirupama, a few clarificatory questions. One, you're talking about home loans only, right? No other kind of loan.
Right.
The second bit would be when you're talking about the gap, when you're calculating the gap, do you know the sale value of that specific unit, or is it a comparable unit in that pin code or suburb?
No, it's that specific unit.
Okay, so that'll be a fraction of the total data that you have, I'm assuming.
Yeah, but it is a fraction of the total data, but this is almost like they're mandated to capture this data.
Oh no, actually you'll have the whole information, no? Because you're talking about a loan and then you also know what the actual sale value was. So you'll actually have more or less complete coverage.
Yeah, exactly.
Okay. Yeah, no, that's fine. Thanks.
Sorry. I mean, so basically, I mean, the appraisal taking a different period than the properties.
Right. No.
So basically, people have incentives to sell the properties. The properties, no, the market starts to go up. I mean, people try to cash in this. So I'm supposed to expect to see a gap, and this has nothing to do nothing to do with the with this the traditional gap. I mean, that you try to address. Is that correct?
I'm not sure. So is the point that it could be just some market forces, and what I'm capturing, what the lender is doing, is that his assessment is that the property values are going to go down, and that's why he's saying that the appraisal value will be lower.
No, let me fill in the gap. Nirupama, so what happens in Australia, for example, is that you can get the property appraised by a mortgage broker or somebody, and then sell the property later on. But correct me if I'm wrong. The case in India is that when you are buying a property, you approach a bank, and the bank will do the appraisal basically for you, and then decide how much it wants to lend. Is that basically what you're talking about? Is that the appraisal that you're talking about? Yeah.
Exactly.
Okay, so that's contemporaneous.
Exactly.
That's contemporaneous.
One. The latter one, and where the lender basically commissions the the appraiser and then gets an appraised value.
Yeah. Okay.
Sorry, but this is loan is for the loan to buy the property, or is any loan?
It's loan to buy the property. So basically, these are collateralized loans. And so for a collateralized loan, the underlying, if the borrower defaults, the lender can actually have access to the.
So basically, this market property, there's not the real value of the property that was sold in the market. But I mean, having a gap doesn't capture. I mean, it's just capturing perhaps a valuation of the property itself.
It could be, but then it's different. It's like there's a difference between minority and non-minority borrowers.
Yeah, because might be that the minority properties are the ones that are not desirable. People want the other.
But that should be reflected in the property value.
Yes. So basically, yes, this should be on the property. Oh, I see.
But we are normalizing that.
Okay. In fact, can be displayed on your side. Right?
Yeah.
Okay, great. Thank you.
Yeah.
Just one more clarification question. The appraisal, the appraisers, do they have to follow like a form and like a rubric and explain everything, like items that lead them to a conclusion of the value of the property?
They do, but there is again a lot of, I mean, there is a lot of discretion that they have, in the sense that, not the borrower might not know all the details of, the comparable properties that it's being pegged to, and so on. But they will make this available to the borrower, and the borrower, can, may have an issue with it, but there are like very limited avenues for them to sort of contest the final appraisal value.
I see. Thanks.
Nice questions. Okay. Okay, so just to recap this, appraisal value is the valuation of the collateral by the lender. So which means that for a given loan to value, appraisal value determines the amount of loan that a borrower receives. And so very precisely, the appraisal value is the log of appraisal value to property value. And it's important to note that we are actually normalizing by, or this is relative to the property value. So we already control for all differences across properties, which should be reflected in these market values. And so if you look at the appraisal gap, the median value is 0, and this is very similar to what has been documented in the US, where the appraisers don't sort of value it above or value it below. Valuing it above would mean like there might be significant credit risk, because the lender would then base the amount of loan he gives on that appraised value. But when we look at non-minority borrowers, again, you find that there's a lot of bunching around, or the median value is 0. For minority borrowers, on the other hand, the appraised value is much lower than the property value. For Muslims, the median is again negative, much lower than non-minority, and for OBC, SC, ST, it's even lower compared to both non-minority as well as Muslim borrowers. And if I do the split between OBC and SC, ST, again, we'll see the same thing, that OBCs fare better, OBC borrowers fare better than SC, ST borrowers. Okay, and so the bunching that I was saying is more evident here. So you see a lot of bunching in the center. For non-minority borrowers, you see some distribution, but you see for minority borrowers a little bit more on the negative side for, as shown by these blue bar lines.
Nirupama, quick question. So why would you in general expect the gap to be positive? Because I mean, my experience, wouldn't it just be that the good outcome or the best outcome is just that, the bank will accept the sale value and that's it. That'll be easy.
But that's precise. But basically in India, there's a lot of black money component. So it could be that the total, everybody knows that the total value of the property is much higher, and so the lender might be willing to lend based on this actual full value of the property. But I have a picture later on, which basically, I think, let me get to it. It's actually quite interesting. So if you look at it, it could be that this is the white component of the property, and then there's some black component, and so especially in this case, supposing this is the white component and this is the black component, but the appraisal value might be high, and the lender always takes a 20% sort of, or the appraiser always like says, let's appraise the value at maybe 20% lower, because there might be other issues. I can't really easily go to court and seize this collateral, and so the appraisal value in this case will actually be higher than what I capture as the property value.
I see.
But even in the US, there are instances where the appraisal value will be higher than the property value or the market value, and And there is, the papers which have documented that when the appraisal value is actually lower, then the borrower sort of retaliates. He has avenues where he can sort of contest this appraisal value.
I see.
So again, we see when I look at the split between Muslim and OBC, SC, ST separately. Again, we have non-minority bunching more more bunching at 0 for the non-minority borrowers. For Muslims and SC, ST, and OBC, there are more negative values, and more so for OBC, SC, ST. I think like the Muslim is not visible because it's hidden behind. Yeah. Okay, so there is significant, so these are at the pin code level, so which are zip codes or small neighborhoods, and there's significant variation across the country. So it's not just driven by, some states some states are not driving all of this variation. And so the baseline specification is basically going to relate appraisal gap to a difference in, how this differs for minority and non-minority borrowers. And so I use the appraisal gap, which I had defined in the previous slides. And this is at the mortgage level. So this is loan I in time period T. So this loan I has been originated in T for where the property is in district D of I in pin code P of I. And so the most stringent specification includes a pin code time fixed effect. And my coefficient of interest is this indicator for whether the borrower is a minority borrower. And I also include certain controls. And so typically on the rate sheet, we have something like for different buckets of CIBIL score or different buckets of the credit score. There are different, rates available and different kinds of loans available for a borrower. And so I'm basically comparing within this bucket at the national level. And in various specification, I include other controls, but not in the baseline. And the standard errors are clustered at the pin code level.
Sorry, Nirupama, aren't appraisal gaps negative? How can you take log?
No, sorry, I should say that, like, I've double counted the log, so this is already logged, right? So this is my dependent variable.
I see. Okay, yeah, cool.
Okay. So looking at the first column, here I'm only including district and time fixed effects, and the appraisal gap is minus 1.69. And then when I start including the controls, which is basically controlling for the credit score, there's a marginal decline or there's a narrowing of this appraisal gap. And much more so when I include the pin code time fixed effect. And so comparing this estimate with this, or maybe adding the controls, this estimate with this, also tells me that the across pin code variation is basically 31%. Overall, this estimate of minus 0.169 translates to about 400,000 lower loan amount for minority borrowers. And assuming the average loan to value of 59%, it corresponds to about this should be lower. It should be about 60% of this. Sorry. This basically translates to about 400,000 lower loan amount, assuming a 60% loan to value and an average property value of 4.6. And if you look at loan to values, you actually see not much variation. And
sorry,
this
there's
might
a question. There's a question. Yeah. Leandro, you're again on mute.
Oh, okay, again. Sorry, I mean, this 50, I mean, what I mean, just to give more or less an idea about this effect, I mean, what does it mean in terms of, for those that are in the minority, what is percentage this represented in the property, or the value of the property?
Oh, I should have the.
I mean, I would say it's sizable, but I don't know. I mean, this is just, I mean, I don't know what is the.
I get your point. No, so the it should account for a large share, and that large share is actually, by large I mean like about 40%, and it should account for a large share. It's basically coming from, for example, this is okay. So let me, yeah. So basically, this is for the set of borrowers who have got a loan. And so, so there might be some culling at the origination itself. Some might not have gotten loan approvals. And so the sizable portion of the loan comes from Muslim and OBC borrowers who actually fared better, especially OBC borrowers. And this SC/ST fraction is actually going to be much lower. I don't have the numbers of the, I should have these numbers. I don't have these numbers. But together they should account for at least like around 40%. Of loan, like the number of loans.
Okay, great. And please continue.
Okay. Okay. So, so the one might be interested in, okay, maybe there is this difference in appraisal value, but maybe there is an adjustment on the loan to value. And so in effect, there might be no effect on the loan amounts. And I want to show that there is a sizable effect. So there's actually not much variation in the loan to value across minority borrowers. And, this basically corresponds to a very small amount, about like $50, about $60. And it could be that loan to value is a much more widely scrutinized variable. So, for example, even the fact that the state-owned lender is capturing the status of whether a loan belongs to a minority versus non-minority borrower, that basically tells you that this is a very scrutinized sort of measure, even at the regulatory level. And just like what my back of the envelope calculations showed us, there is also a sizable effect on sizable negative effect on loan amounts that the borrowers can access. Okay, and now I'm going to actually just do different cuts of the data, and this sort of establishes two things. One is that there is significant spatial variation in the appraisal gap, and second, it also gives us comfort that this is not just some outlier, some quirk in the data that's driving these results. And so here I'm going to show the state level estimates. So for different states, I look at the subsample of mortgages in each of these states and then just rerun my baseline estimate. So looking at the difference in appraisal gap for minority borrowers. And you see that, for the most part, it's negative and significant. Maybe Nagaland is the only one which is positive. The others are close to zero or much more negative. And then I do the same thing at a more granular district level. And we run the baseline estimate for districts which have at least 500 observations, 500 mortgages. And of the 613 districts, this is satisfied for 452 districts. And the point estimates are negative and significant for about 162 districts, negative and insignificant for 391 districts, and positive and significant for 54 districts. And positive, positive and significant for 54 districts, and positive and significant for a smaller number. And so this gives the point estimates. I've not shown the confidence intervals. And again, you see this same trend that it's negative for a large part and positive for a few. And the year-wise estimates also show this, throughout we see this negative trend, though you see that, it was worsening up until 2018, and then there is some flattening out, and even maybe the negative becomes less negative in a relative sense. And this has to do with a lot of policies that were put in place, especially the RERA Act in 2016, which was implemented in a staggered way by the different states. And so you see some of that taking effect. And this is heterogeneity across minorities. So I've clubbed all together all of these categories into one group, but now we want to see the effect across minorities, and we find that, and this is, this squares with what we saw also in the aggregate statistics. That is, for Muslim borrowers, there is a negative impact, but the impact is worse for OBC borrowers and much worse for SC/ST borrowers. Okay, so now I move on to the exploring the different channels. That is this effect coming from some kind of spatial variation? And essentially, this helps us also think about the kind of mechanisms that might be driving the results. So are the effects due to high minority areas? And so this looks at the heterogeneity. So this minority fraction is calculated at the granular pin code level. And I want to look at the variation for minority borrowers overall, and also minority borrowers that stay in these sort of segregated neighborhoods, or neighborhoods where there is a high minority fraction. And I find that, yes, there is a baseline effect, a negative effect. And this is much more so for minority borrowers that stay in these high minority neighborhoods. Or in other words, minority borrowers even within very narrow neighborhoods where there are more minority borrowers fare worse than the non-minority borrowers in the same neighborhood.
Nirupama, a few questions. One is, I mean, this is maybe I should have asked this before you started the mechanisms, but do you observe loan outcomes?
Yeah.
Okay, and do you do something about that? Because you see what I'm saying? What you're doing is intensive margin, which is all fair and all good. Right. But what you're saying possibly is an understatement, possibly because quite a lot of applications may be getting rejected, and more so for minority borrowers. So the overall distortion is probably larger for minority borrowers.
Right. Okay. I think I didn't understand. So now I get your question. So I'm documenting a very specific sort of issue, right? Which is the appraisal gap. I think if my question were broader, which is that does this affect just the credit access for minority borrowers, then all the issues that you're saying make sense. And in fact, this is actually a carve out from like a broader paper which looked at redlining in India. And the idea there is, like, again, to look at the extensive margin. That is whether the minority borrowers actually get less access to credit. Here I'm actually focusing on a very a much narrower sort of problem, because I think it is, even this has not been documented in the Indian context or in any developing economy context.
Right. No, I agree. I'm just saying, maybe if you have that information, just a figure that shows the proportion of applications that are accepted or rejected, for that matter. And if that is skewed against minorities, then you can make a nice point to say that whatever I'm saying is possibly just a lower bound. Just a suggestion. The second bit would be, together with that, maybe also see if maybe you're exploring this as well, but maybe see if repayment rates or non-performing assets are also homogeneous. Because if they're not homogeneous, and that may be again a endogenous response by the lender to kind of do this systematically. So that may also be a mechanism that you'd want to show. It's a nice thing, actually. If you find something, it's a nice thing. I'll stop there. And Rod has a question.
Yes, if you can hear me. I missed the very first slide or so of the presentation. I'm sorry, but you haven't talked very much about collateral and earning capacity. That is, capacity to service the debt. And do you have information on collateral? I presume, but it may be a very simple conclusion you could draw that minorities have a poorer capacity to pay because their salaries are lower, and or they have lower levels of collateral, right? So you have that data in the system to actually explain this. Your story is that the gap is negative because the banks want a lower appraisal so they can afford, so they have a reason for giving a smaller loan, right? But there are these other reasons for giving a smaller loan as well, that may be more rational and more efficient.
Right. Yeah. So I think a little bit of part of your question is related to Girish, but the sort of the let me try to answer together. One is that it could be that minorities have lower value properties, but again the way the measure is it's already accounting for the differences in property values. So the argument should be over and above this property value. And so the other kind of point I think you were making is that there are two sources. There are two reasons why the lender might not be willing to give a loan. One is there are differences in borrower characteristics, that is his ability to pay and so on, which is again, I think what Girish is also saying. And the second is that it's differences in the collateral value. And so for differences in the borrower characteristics, I do have information on the default properties, and I show that this is not driven by that. That is, even after I control for differences in borrower the exposed default rates, the results, it explains none of the variation actually. And that could be because I'm already controlling for credit score in my baseline, sort of the most stringent specification in almost all of the tables. And the other
go on.
Sorry, go on. Yeah, I can't see you, so I'm yeah.
I'm sorry. Yes.
Go on, please. Yeah.
The other question I had is that all these data seem to come from one state bank, right? Now the individual states in India have their own banks too, I understand, right? So that one wonders, when you show that map of India, it looks like this one government-owned bank has sort of a high level of loan issues throughout the country, but in fact it probably doesn't, right?
No, that's not how it works. Yeah, it doesn't work that way in India. It is a national bank. None of the state-owned banks are for a particular state. They're actually regulated by the federal government.
Right.
So they're not state-specific.
Right, but one imagines that some of those banks would be more have much of their activity more concentrated in some individual states than more so than others, and so on. That is, it might have non-uniform coverage around the entire country. It's not.
No, this is the data this is my data. And you're saying there could be some variation. I don't think so. I think this is the largest state-owned bank, one of the oldest, and it does have the most expansive reach across all, as in it's a cut above the the other banks. So it's going to have the most not have that much geographic concentration.
Okay. Now I just thought, were there any geographic variation, then that's going to influence also the relationship you have between minority borrowing and the level of borrowing and appraisal. So, but if that's not so, I mean, if this bank has very uniform coverage across the country, then that's certainly not something you need to worry about. Yeah, thanks for that.
And that's why I do different cuts between state level, district level, and so on. So it's not just driven by these maybe spatial concentration. Yeah.
Okay.
And yeah, the repayment data, Girish, to your point, I don't have that, but I can think about it more carefully, how it would influence my results. I guess your idea is that it differentially somehow the appraiser and the lender knows that there are differences, and that's what is being captured. Right. And the way I have not yet done it, but I think there is something about the interest rates that I can exploit. So for example, for borrower creditworthiness, I've exploited the NPA, but I think I can, if it is priced in, then I can control for interest rates and results will also flow through. And I need to think a little bit more about the argument, but I think
yeah, if you get action, that'll be nice, because that's that's another explanation of what's happening.
Right. Okay, and then so I'm on minority fraction, and I find again that there is. So I have I have about 20 minutes, right?
That's right.
Okay, great. So I find, again, this is just looking at different cuts. And again, the idea is to just keep repeating this exercise so that we get some comfort that this is not driven by some quirk in the data. And I find that if I look at different deciles of this minority fraction, again, the effects are sort of increasing as the minority fraction keeps increasing. Then I look at segregation differences. This is district level segregation. That is how segregated minority borrowers from the non-minority borrowers spatially. And again, there is this baseline effect, but also the effect is much more so in districts which are more segregated. And again, you see this sort of, decline, more negative effects for more segregated districts. I also look at differences by wealth, and let me flip this side. So the poorer the neighborhood, the worse is the appraisal gap. And again, when I look at different cuts, there is this increase in appraisal gap across for wealthier neighborhoods. Okay, so this one, the mechanisms is where I think, where the meat of the paper is. Because the mechanisms in the Indian context are going to be very different from what has been documented in the more developed economies. And so I'm going to explore three different channels or mechanisms. One is there are differences in the black component of property prices. There could be differences in, and some of this has come up. So differences in borrower creditworthiness and differences in collateral values. And so this is basically going to be, the punchline is that it's not either of this, but I think this will take the most of our effort to sort of pin this down exactly. Okay, so the black money component, real estate transactions typically involve partial payment with off-the-book sources of money or black money, and this is typically done to avoid taxes. And so one can argue that it is just something about about the way black money is not captured that is driving these differences. For example, here's just an illustration. So think of a low-value property. Maybe this is minority borrowers have property values which are lower priced, and and we know that higher value properties actually have a larger black component. And so the low value properties, the black component is less, and say the appraiser or the lender always takes this cut of 20%, accounting for differences in other differences why he might not be able to actually seize the collateral. And so the appraisal value will be this much. And so if you look at the appraisal value to the book property value, which is what is captured in the data, that will be sort of negative. For a high value property, again, there's a bigger black component. And so if you look at the appraised value, it might actually be more than the property value. So appraisal gap is greater than 1. And so maybe it's just this variation that we are capturing. And so again, I repeat the same exercise as before, that is look at different property values. And it is true that so we are, again, each of these lines is, each of these estimates is basically capturing the difference between minority and non-minority borrowers in appraisal gap for low valued properties and for high valued properties. So consistent with what the previous slide was sort of speculating, it does seem that the gap becomes narrower, or it becomes more positive as for higher valued properties. But even at this top end, there's still this negative effect. Okay, and so to test this, again whether it is about this black component, I actually look at the occupation of the borrower, and then I'm able to split it into two buckets: salaried borrowers and non-salaried borrowers. And the idea is that salaried borrowers will have access to less black money compared to non-salaried borrowers, and so that gives me variation in the borrowers who had more or access to black money versus less. And so I think there was so it had not come up, but I think somebody had mentioned salaried. Actually, they mentioned the level of salary, so it's not exactly that, but consistent with the hypothesis that I hypothesized here. So it does seem that, and if you look at this, the appraisal gap here will actually look higher than the appraisal gap here. And consistent with that, if the borrower is salaried, then the appraisal gap is lower. And this basically might be accounting for the fact that for salaried borrowers, there is less black component of money or less hidden value of the property.
Nirupama, there's a question by Rod.
Yeah.
Sure.
Apologies for this, but the diagram you have is very interesting. The question I have, though, is how does the bank know how much the black money component is, right? Presumably, you apply for a loan based on the various factors the bank requires, and then you have a separate deal with the seller of the property, and then black money goes under the table to the seller of the property. How does the bank know? How does the bank estimate what the black money component might be in order to influence its appraisal?
Yeah, so this is this I'm not sure, but this is one of this is a project I tried to start in the very beginning, but we had found out that some of the private banks even record the black component of the property. So it's not that it's like they do get an estimate based on, say, for example, most properties in a given area the black component will be everybody knows sort of what the surrounding properties are selling for, and so there is some estimate of what the black component is going to be. And the second part is that in some cases, not in our data, but for some private banks, I've also heard that they actually record the black component, and then they base their loan to values off of that, the combined.
The question is, how do they do that? I mean, one way might be to say, well, we're offering this loan, and we know how much collateral the borrower has, and then we observe what the actual selling price is, and there's a difference, so we simply count that as black money. Is that the sort of mechanism they might use?
So tell me again, they know the sale price, and then
So if the bank knows what the capacity to pay of the borrower is, it knows how much loan it's given, and then it observes the actual sale price. And that's presumably negotiated after the loan is known, right? Then it can there's a difference, and it can put that difference down to being black money, a black money component from the borrower. Might that be the mechanism?
No, I'm not sure, because that is almost like they decide the loan amount to make, and then they backtrack how much we can capture as the true value of the property. I think it's actually going to come from the sale price versus, the appraisers might be able to get a sense of what properties are selling for, and they also know what it looks like on paper, and then they're able to get a gauge of that.
Perhaps. Okay. Thank you for that.
And so so this again consistent with this hypothesis that I set up in the previous slide.
Sorry, Nirupama. Maybe one more question by Sean.
Sure.
I think my question is following what question asked.
Sean, we can't hear you.
Can't hear me?
Go ahead. I can hear you now.
Can you hear me?
Yes.
Okay, great. So I'm just wondering, so can you just still clarify this issue, because now the appraisal gap, just like ratio between these appraisal value and the sales price. So here just try to say now the appraisal value is below the sales price, so you just attribute it to the kind of nation. But I'm just wondering, you have tried to see whether the sales price also can be affected by minority dump. After controlling for a lot of the characteristic of the property, like using the hedonic pricing, and you put the minority dump in the regression I think that is currently your underlying assumption is that this minority will not affect this sales price. It only affect this evaluation. But I'm not so sure because theoretically, so we can say the gap just can be caused by the denominator rather than the numerator. That means the minority may just pay a higher price. But why do they pay a high price in transaction? I do not know. It could be just like black money, as you said, or due to some other reasons. I don't know whether you can show that evidence. I think that it could be make your result more convincing, reliable, and also deal with these black money issues. I'm not so sure how you measure it, but actually it should just affect this sales price, right? According to my understanding.
Right, and I think yeah, this is a good point. So at the and I we have to do a little bit more work to address this specific point because we don't have. I think like the idea is that we need to do a hedonic pricing because it could be that the structures that minority households like might not might be very different from non-minority households, and maybe the lender will not price in this higher property price that the minority borrower is willing to pay for this particular collateral. And I don't have a specific answer, and right now I'm just relying on this property prices for my basically this is everything relative to the property price. And why would the I'm just going to give you the punchline for the future slides, but I do find that many of these gaps also come from lower collateral values, and it could be that maybe minority borrowers don't know that this is almost like they can't get loans against this collateral because it's their property rights itself are not very clear. So one way to sort of estimate that is sort of going down the road of like thinking about more financially savvy or more borrowers who have more access to lawyers. Maybe they are able to gauge the true value of their properties. But I think it is part of the channel. I'm looking at it as like a part of the channel as to like why minority borrowers might be willing to pay more than in a relative sense than non-minority.
Yeah, I think if the discrimination is a story, then it can be discriminated.
Yeah.
That can be discriminated in both markets, in both the mortgage and loan market, where they get undervalued appraisal price. And
Right.
there was a discriminated in the property transaction market. That means they have to pay a high price.
Right.
I think both can lead to this gap. But so far, yes, I do not know which. Yes,
Right.
we can
Yeah.
yes.
I've not
Therefore,
come
we
to
cannot
what it is.
distinguish the both channels at the moment from this gap.
Right, but I would say that like till now I've not told you what it is. I've been saying what it is not, but let me get to quickly what it is. And it's going to be like a lot of it is actually going to come from differences in property rights. They actually don't have clear. Yeah.
Quickly, can I just say that we just have 5 more minutes, so let Nirupama complete her slides, and then we can ask questions if we are keen and if she's happy to stay on for a while. Please, Nirupama, go on.
Sure. This is I'll just speed through some of these things. So we also look at I think it's come up. So I'll just mention that we also control for ex post default, and the negative effect still remains. And then I think the sort of now what it is, right? There are differences in collateral values. So maybe there is asymmetric information about collateral values, and there's more ambiguity about the property rights, and even it's much more difficult to enforce those property rights. So we have data on, so the lender now also gives loans to developers, which it sort of has a tie-up with. And so the lender and the appraiser know more about the kind of collateral, the quality of the collateral. And so I look at the appraisal gap and differentially how does this look for minority borrowers who are borrowing from integrated developers. And it does seem that the gap actually narrows and almost disappears for these integrated developers. And so even conditional on these developers that are sort of even conditional on the loans that are coming from these developers, there is variation. So if you look at, so for example, if I just look at minority borrowers within within one specific developer, the minority gap actually disappears. But if I look at all the loans coming from integrated developers, there's still a negative effect. And so this seems to suggest that there is something about the collateral value or difference in the collateral value that is driving these results. And even though this is only for a subset of borrowers, the effects are still there. So I look at like without the developer time fixed effect, and the effects still remain, albeit smaller, because again, this is a very select set of mortgages where the lender does have trust in this particular developer. But even across these even within the developers that are vertically integrated, there is a sort of a variation, and there are some, a subset of developers where you still see like a much worse effect. And without going into specifics, there does seem to be a matching of minority borrowers to much worse developers. And so the RERA Act was a game changer. It basically regulated the real estate sector, and mostly it regulated developers. So it made it very transparent. The developer now had to, there was a mandatory project registration. There was also a state regulatory authority set up. There was an escrow account where the depositors had to develop almost 70% of the funds that were collected for a particular project that had to be put into a separate escrow account. And this was almost like a Ponzi scheme where developers did not do that before. And there was a lot of other information that needed to be made available to the home buyer. So, the carpet area basis, so that the home buyer knows exactly what he's paying for, and so on. And also grievance redressal mechanism. And so there's a staggered implementation of the RERA Act. And we find that the overall post-RERA, there was the appraisal gap narrowed. And all of that effect is driven by these worse developers. Their collateral was actually valued much better. And note, this is even for the integrated developers that this lender has this largest state-owned bank has a tie-up with. And the IBC amendment just goes along in the same direction, and we find again very similar effects. Okay, and I think the sort of the big the previous results were for the subset of borrowers where the lender and the developer had a tie-up. But the big sort of problem which is unaddressed is property rights, and we hypothesize that this is sort of one of the big reasons why there are differences. The data on this is not very easily available, so we focus on one case, Delhi, the national capital. And property disputes actually account for a large fraction of the disputes in Delhi. And this is almost like, it's a bit well known that Delhi has a lot of disputed properties, which is why you don't see like a lot of high-rise buildings or anything, because like in most areas, most properties are disputed. As opposed to say Bombay, which is in a relative sense, Bombay is a little bit better off. So we collect data on disputed properties, and we also collect a subset of another set of Section 81 disputes, which has more to do with poorer colonies, with slums, and it deals with cases which are registered concerning unauthorized colonies. And the reason I collect this is because in starting 2016, there were talks that the ownership rights to these properties would be transferred to the slum dwellers, and so it sort of gives again, can regulation step in and maybe help narrow these gaps? And I find that for in regions or these narrow neighborhoods where there are more disputed properties, this is normalized by population. I find that there is an effect. These are noisy, but there is an effect for the OBC category and not so much for SC/ST. And if I look at the slum dwellers, I find that for SC/ST borrowers, again, there is a positive effect. again coming from this idea that there was this move to transfer the ownership rights to the slum dwellers since 2016. And if you look at before 2016, the effects are actually negative or non-existent. Okay, and there are also differences in enforcement. There should be enforcement, which is at the district level, and here we collect data on judges per normalized by population. And so the idea is that if the judges or the courts are able to enforce property rights, then we should see more of an effect. And you see some noisy effect, but this doesn't sort of remain as for more stringent specifications. And so more broadly, I think the property rights part is the one that we are focusing on. And so the goal is that we are going to scrape data from Pan India, from the courts database, and try to link it, and then sort of pin down the channel that is driving appraisal gap through these differences in property rights. And the challenge has been that like the property rights are a bit murky, and they differ a lot region to region. And also like determining what it means for a property dispute to be won in favor of one party versus the other, even all of that is a bit challenging. But that's what the next steps are going to be. I'm going to conclude. We document significant appraisal gaps for minority borrowers in India, and many inefficiencies drive appraisal gaps, but there is scope for policy to intervene. And if I compare it to the case of, or the historical context of the US, they also had much disparity from disadvantaged groups, both at the borrower level as well as at the spatial level. So there is, papers have documented this idea of redlining and so on. However, subsequently in later decades, when other policies have tried to undo the effects of redlining, sometimes there have been unintended consequences. So, for example, in my own paper, I find that targeting maybe certain disadvantaged neighborhoods and increasing credit access there actually resulted in a white flight where the non-minority borrowers fled to other neighborhoods. And in our case, we actually look at non-targeted reforms. So all of the reforms I mentioned, the RERA as well as the IBC, were much more broad-based. And they differentially affected or differentially helped disadvantaged groups. And this could be because the inefficiencies basically fall on the minority borrowers in the ex-ante world. And the main takeaway, at least from the last part of the analysis, seems to be that fixing property rights can lead to welfare gains. And the idea is and this is like an old idea, where poor property rights, especially in developing economies, might lead to this idea of debt capital, where both because the borrower doesn't, or the household doesn't have property rights, he might not be willing to invest in it, or or be able to rent it out, or even get credit access against it. However, fixing these property rights issues is politically charged because, in a sense, it is about redistribution. For example, the case I spoke about for slum dwellers essentially transferred the ownership rights from the landowner to the slum dwellers. So I'll stop here.
Excellent. Thanks a lot, Nirupama. Interesting paper that generated a lot of discussion. We are slightly over time, so let us thank Nirupama for her presentation. I'll officially end the seminar, but if there are any questions, and Nirupama, if you're happy to take them, then maybe we can take those questions now. Any questions? I don't see any. I just have a couple. One, I think I quite like the suggestion by Sean, and that's a good point because it's possible that if there's discrimination in the sense that minorities are overpaying for houses, then even in a efficient lending sector or efficient credit sector, if banks are basically valuing, let's say, or giving credit to 50% of the home value, and that 50% of home value would kind of be lower for non-minorities and higher for you know so that in itself will generate the gap that you're thinking of, right? No, hold on. The mechanism has to be opposite, no? I'm just trying to understand which way it'll go if the discrimination is that minorities are paying more. Um, yeah, no, it'll generate the gap exactly in the way you're finding, right? So that's one. So maybe one way to go about it is you have this loan data. So won't you have information about, I don't know, floor area, number of bedrooms, number of bathrooms, etc.?
So I will have not number of bedrooms, number of bathrooms. I will have like the only floor area. Uh, and the issue always is that it could be some feature of the house which is also different. Like I need to do a proper hedonic pricing, but I'm not sure I have the data. But I will think a little bit more about it. Maybe with supplementary data, with census data, I can do something.
Right, right. And again, maybe you have thought of this, and maybe I didn't absorb this, but when you talk about the black component, is there more to it than what we have discussed, in the sense that if the black component is heterogeneous, not just for low and high house values, but for minorities and non-minorities, so the proportion of black value itself is systematically different for black and minority and non-minorities, then again, if the bank is basing the collateral value as a fixed proportion, that may again give you different results, because the bank kind of knows that that's the value of the house. It's just that for minorities, for some reason, they're either having more black component or less black component. I don't know. I don't have a prior there. But if there is some such thing going on, where the proportions themselves of black and white is white, but yeah, the black and the documented component is different among minorities and non-minorities, then maybe you get some action there as well. I haven't thought this through, but maybe this is food for thought.
Yeah, and this is interesting, and I think that was my prior too. So if there is reason to expect that the black for minority borrowers, there might be more black component or less black component, because minority borrowers do tend to be in the more work in the informal sector, and so we might expect that there is more black component. So which is why I use this one variation, salaried versus non-salaried, but there is scope to do more. So there could be regional differences in black component, and you will find variation across the like Delhi has more black, Mumbai less so. And so if I find a Delhi versus Mumbai difference, it could be this. Yeah. So there are like, I think even if you notice, there are like many mechanisms, and probably many mechanisms are at work, and one can't like decompose each one because there are many inefficiencies. But the way I've approached this is, what have we, like the big stuff that we have fixed some of this. So the RERA fixed a little bit, one component, and yeah.
There's a question by Rod.
Yeah, thanks. But I find the paper interesting, and there's a great deal of analytical detail that's going on here. But I'm wondering about the big picture here. That you have enough data to say, well, is the housing market in India efficient? That is becoming more efficient through time, and is it serving the whole of the Indian population increasingly? So this doesn't relate directly to your paper, but it's interesting to me to know, for example, is the formal bank loan component of housing finance increasing through time in India, for example? Otherwise, people who are in houses, maybe in slums and elsewhere, they have various forms of informal debt to often, unscrupulous landholders and so forth, right? So if we're moving away from that to a formal bank lending mechanism for housing finance over time, that's got to be a good thing. And if the minorities are increasingly being lent to over time, then that's got to be a good thing too, hasn't it? I'm just wondering what the data says about that. Because in some sense, comparatively, I mean, the poor are always going to be poor because they're poor, right? And and we can get into a cycle where we're just grinding away on that the whole time. But if we take the big picture and we look at the overtime changes in the proportion of the poor who are actually being financed through state banking systems, that could give us a little bit of better news. I'm just wondering if you have an impression about that.
Right. Yeah, no, this is very interesting. And this is, I think, under the core of like, the 2-3 projects that I'm doing now. And especially in this, the prior, so it's true that the government is trying, the real estate market has been very inefficient because of this murky property titles. And I think the prior was that, one can't do much to fix the inefficiencies. And in fact, when the RERA Act, which I looked at, when that came into effect, the prior was that it would help only the very rich, but probably hurt the poor, because developers might find it the regulatory burden is so high that they might be forced out of the market and hurt minority borrowers. And so this finding was interesting, that even something very broad based, which is not targeted to minorities, did end up helping minorities, because the inefficiency was actually much more prevalent there. And with regard to the other set of papers,
that's an important point, by the way. That's a very important point to emphasize, I think. The glass half full point here.
Right. And it's, especially with mortgage markets, it's a bit more difficult as opposed to the other sort of parallel thing that's going on in India is this digitalization. So because lenders are now lending based not on just on collateral, but on whether I have money flowing in through digital transactions. So more cash flow based lending. So you're seeing a lot of formalization of borrowers getting access to formal credit there. But I think with real estate, it's going to be a lot more difficult because of these property rights. And because inherently there is this, if we formalize, if we say, okay, this property right belongs to this person who's staying there, the slum dweller. So probably you're like taking it away from, there's this redistribution away from like maybe landowners to slum dwellers. So I think it's a little bit more slower. We'll see a little bit, improve a little bit slower.
Do you have an answer to the question though? What proportion of total housing loans are now bank financed? Total housing purchases are bank financed, right? So that is the movement from what would originally have been a largely informal payment for the cost of housing toward people owning their own houses to a greater extent. Right?
I don't have it, but there is a very nice database I can get that number from, which is survey based. But yeah, I know why they're borrowing, and they borrow mostly for housing and for education. And for housing, it comes from from friends and relatives and from the formal credit. But I can get an estimate.
Yeah, I mean, it seems to me there's potential further good news in that. If the system of providing housing is becoming formalized over time, right? Very much like the rest of the financial system in the economy, where you'd go back 50 years and you'd find most of the financing has to be informal one way or another of any kind of investment, let alone housing. But over time, you find that the banking system and the formal regulated institutions carry a larger and larger share of the total financing. Which then gives government policy much more influence. That's the kind of thing that we've observed in China, for example, but I'm just less familiar with India, whether that would be true there too. Okay, for that and for the seminar.
Thank you for the question.
Excellent. Thanks a lot, Nirupama, again, and all the best with the paper. Oh, I see there's a question by Luciana. So
just a quick comment. I know it has nothing to do, with all the work. It's not the scope of this work, but I'm wondering if the rental market, the discrimination would be even more pronounced.
Right. So that is a whole another can of worms, because there is also differences in how the rental contracts work across regions. So, for example, in Bombay, the renter has more rights compared to, say, maybe Delhi and other regions. And there, because renters have been squatting on properties, there is again, the property title is again very murky, and so And also, sometimes owners themselves might be, even if they own the property, they have mortgaged it, they might just like not do anything with it, not put it out into the rental market, because they're worried that this renter will come in and claim the property is his. Because after staying for more than 11 months, the renter, I think, gets like even more, he has some claim on the property. So I'm not, yeah. But that's again a very interesting question, and I think like there's so many inefficiencies, it's a bit difficult to know where to focus, but yeah.
Excellent. Well, thanks, Nirupama, again. All the best.
Thank
Thanks
you.
a lot. Thanks for all the questions.
Take care. Bye.